You're tuned in to Agriculture Today, and we start our Friday show with the grain market update from K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, what are we seeing in the futures market?
Well, we're in February, and this is the time coming through the time frame after those what's well known as the first 5 months of a marketing year following harvest, when when generally if we're going to see many exports, this would be the time when we're either topping out and starting to move to the lower side. And there's different factors to that. This year, that has held firm as a kind of an idea in the corn market. Here we've got for the week ending February the 13th, we have an early week estimate of about 63, 64 million bushels shipped, and that's the highest for this time of year on record. So strong exports, really a positive number, positive if not bullish, really for corn. And so that happens when uh, the second crop corn down in Brazil is being planted. We still have a window when the U.S. is really without a lot of competition in that area. That window will close as that Brazilian crop comes on. There are some concerns about late planting. It's tied in with the uh, soybean harvest that's going on down there. And a lot of areas, most of those areas, they have to move the soybeans out, get them out of the field so they can then get the corn out. So we got that going on, and because of that, we've seen the corn market really jump. Well, keep moving really pretty strongly to the high side from back in October when we were down at about 412, 413. Here we've climbed up to 498 for the March contract. On the close, we were basically over 506, 507, something like that. So really a time of some strength. We do see new crop corn did close at 479 and a half. And we were kind of grain analysts wondering about the priceability of what we're seeing out there in December for corn when we were at 440, 450, something like that. Now we've moved up closer to five, and some people are probably considering what to do, and that's really before we've had any worry about what's happening in the U.S. So for planting season and crop production areas, so some strength in the corn market. For soybeans, still holding in decently. Again, that South American crop coming out of the field now is poised to be quite competitive with U.S. soybean exports. We still shipped about 26, 27 million bushels for the week ending February the 13th. And we need a year-long average pace for the remaining weeks this marketing year all the way out to the end of August of about 18 million bushels. So uh, it there's probably no doubt that unless there's some shortfall in production in South America, that there'll be times when we move below that number, and we'll see the I guess the aggressiveness of China entering into those markets to buy from either the U.S. or Brazil, and they've certainly shown a tendency because of trade issues, trade contentions to buy from Brazil when it's available. So we'll see where all that goes. So we saw soybean futures close yesterday at 607 and a half for the March contract. The Well, pardon me, that's sweet. It would be 1045 and a half for the March contract, November 1061 and a quarter. And in most of our memories, we're thinking of 12, $13 soybeans as something a lot more attractive than what we're seeing for November beans at 1061. But again, we have our own planting seasons and all that to go through yet, but that's kind of where we stand at this point. And then for wheat, uh, really right now we're here in the hard red area where we've got strong amounts of U.S. hard red winter wheat carryover. By strong amounts, I think we talked about this last week. In the last USDA report, we have showed that we have a 57% stocks to use figure for wheat for this marketing year that'll end in at the uh, end of May, before June 1 starts the next one, 25, 26. And we've got, again, about 57% stocks to use. So for every 100 bushels that we're using, we have 57 sitting around in the bin waiting. That's by far the highest of the wheat classes in the U.S. Last year it was 48, and that was also a challenging year. So not a lot of movement at this time. We have seen just week in, week out, some sporadic jumps around in the hard red winter wheat export number, and there's still the issue the if you're a U.S. Wheat exporter, the promise, the hope that that some of the news we hear out of the Black Sea region on, again, Brazil, other countries, well, Ukraine, et cetera, having such strong pace that they'll have to hold back on some of their exports. That'd be Russia. So that may come in and give us some strength. We've had out here in Western Kansas anyway, Western Central Kansas, we've had moisture and a fair amount of snow. That helps things to go well. We had cold temperatures. I haven't heard our agronomists in Kansas talking about. I mean, at Kansas State University, talking a lot about winter kill yet, but we'll see where that goes. We had some awfully cold temperatures. Wheat closed uh, July wheat new crop 632, and so that's at an area where 632 isn't a bad price, but our cost of production has come up to the degree that if we have any type of a basis of 25, 30 under that, for by the time we get to harvest, then you'll be at say 5.90 or $6 or less for wheat, and that's probably that's a price that helps us cover our direct cost of production, but not our full economic costs for a lot of wheat. Again, that's by the time you add all machinery costs, land costs in there, you're getting 6.50, $7, something like that, if not higher. So that's just what's happened to wheat. So interesting to see this overall view of the markets and how what we saw yesterday for closes again offers some hope for corn, some a kind of a moderate viewpoint for soybeans, and for wheat, not bad looking futures prices historically, but with our cost of production, probably need more to actually make full economic profit off the wheat enterprise.
And as we're looking at the grain market, what are transportation costs looking like right now?
Well, they remain pretty strong. It's interesting when you look at as we were talking about wheat, when you look at tariff rates for unit train shipments or shuttle train shipments from, from Colby down to Galveston, basically a Texas Gulf, Galveston, Houston, Texas, basically it's $1.34 a bushel. And some of the latest numbers that again USDA AMS transportation report show basically at South Central Kansas terminal prices, wheat hard red winter wheat in Kansas, that one location about 558. Hard red winter wheat down in the Texas Gulf at 731. So you're reflecting that transportation cost plus a little bit for profitability and handling on the part of the handlers down there. So you got that going on. Also interesting when you look at from Colby, Kansas, out here in western part of the state, going out to let's see here. Pardon me, from from North Dakota to Portland, Oregon. Well, pardon me. Yes, that's right. Garden City out to Portland costs about $1.85. So we're one of the reasons that we don't have as high prices for wheat out here in Western Kansas and Kansas overall is because transportation costs aren't declining necessarily, and you have I guess to be competitive as we're looking at what competitive prices we have to take the cash prices locally and add transportation costs to get them to either Portland or the Gulf, and again those aren't necessarily low hurdles to jump over.
Why is this something that you're keeping your eye on?
I think we'll be coming out of February into March here pretty soon, and there'll be more attention to field work when we can get into the fields. Uh, with that, we typically don't see a lot of seasonality and price run-ups until we get out into April and on into May. And again, what's great now for moisture can be too much moisture later on. And an open spring is great, but that's generally an indication of drier conditions. It's a kind of a two-edged sword. Do you want moisture or do you not want moisture? So all those things are out in front of us, and with regard to our own domestic crop production risks that year after year tend to influence the markets anymore. We have seen the highest prices for a lot of our commodities actually happen in May. So where we're at in February is is uh, is that we're anticipating what could happen out in the spring because of our own internal crop production risks. And if something happens down in South America with lower numbers than expected, that just heightens, exacerbates any price movement that we might see that could happen springtime. And once the crop's in, then we just look around and see whether it looks good or not. And the market, when I say we, that's the market overall, assesses the risks going forward, and then we're into the heart of the growing season, May, June, July, August, and we just see where questions about the crop risk and uncertainty take us overall.
Dan, I appreciate you taking the time to join us once again.
Thank you so much, Shelby. I appreciate it.
That was K-State grain economist Dan O'Brien. Stick around because we're cutting to a short break, but we'll be back with more.